morning, good afternoon, good evening, depending on where in the world you're viewing this from today. I've got with me Daniel Barankin, CEO of Six, my friend and benefactor. Daniel, how are you today?
Hey, pleasure to be here.
Awesome. So today, now we've got the conversation all set up. We're talking about markets, mining, and money, the three M's that consume our daily lives. So I'm looking forward to the conversation. I will say, folks pop into the room. This is an interactive event. There's a chat button on the bottom right of the page. Please do feel free to ask questions at any point during today's event. I'll make sure we can address them as they pop in. I might weave them into the conversation if they work. There's also a feedback button on the top right of your screen. If there's any company you'd like to see on Six, write to us. Please let us know. We'll do what we can. The only other piece of housekeeping for today is this event is being recorded and will be available for replay probably at about 2:30 p.m. Eastern time. So it'll pop right in your inbox using this exact same link. It'll also be available on Six's YouTube page. So view it in whichever format that you'd like the most. But that's enough out of the boring stuff. I want to jump right into the proteins. Stanley, you ready for a bit of a grilling on markets?
Yeah, let's do it. Let's jump right in.
Awesome. So we are seeing, we'll call it volatility, we'll call it excitement, we'll call it energy and commodity prices, and recently mining equities too, which is exciting. So I wanted to throw it to you. In your view, gun to your head, is this a bull market? Are we still waiting for a breakout? Where are we at in the cycle right now?
Yeah, so I'd say this is the start of a bull market. I think things are going to get a lot more exciting. What's really cool is that we're seeing tremendous capital flows pretty much from every aspect, whether we look at bullion prices or if we look at how the majors are doing. I think traditionally what happens is you see a movement in bullion first. Then subsequently, you see that reflected in the earnings that the major mining companies put out. And then subsequently, you start seeing that trickle down to the production stage companies that have a bit of smaller resources, to the development stage companies, and ultimately to the juniors. And so we're beginning to see some M&A activity, but we're nowhere near the scale or the size of transactions that would say that we're frothy. And so I think that all of the momentum that we're seeing, including the multi-100% rises in share price for many companies, I think we're at the start of something, not even in the middle or at the end.
Sure. What people kept telling me was, you've never seen a good market in mining because I started in 2021. You've never seen a good one. You don't know what it's like. I think Beaver Creek was my first taste of, people are smiling. I haven't seen that before. People are in actually a broadly pretty good mood. The other thing is, and you mentioned it, that it starts with majors earnings and then it filters down. The story I think that's interesting right now is developers are starting to move. The people in, that they call it the death zone of the Lassonde curve, where you're in permitting hell or it's just nothing really seems to be happening for years. Those are moving, I think, quite fast. I think they're poised to kind of take off. So it's interesting to see, I think, that movement in markets, or at least that's something I've noticed.
Certainly. I think that looking at most of the majors, what you can see is that they don't have very many resources into the future. Yeah. And so it's very obvious that for a major mining company, you either run out of resources or you start acquiring companies that have them. And so those development stage companies that are historically have been orphaned by the markets for the last 10 or so years, they're very clean takeout targets for majors that need to replenish their assets.
Because with these gold prices, like where the market is right now, you just want to have as much in production or near-term production as you can, just so you can start selling it at these wild prices. So yeah, I think every major is looking at what their next buy is, and I think that starts to rack up some of these developer share prices, which is exciting. I mean, that's the kind of market we like to be in. But I wanted to talk broadly, because for a long time, some people will tell you gold's been in a bull market since last March. But there's been a disconnect until honestly, really recently between commodity fundamentals, but those mining equities. So my question to you is, what are the structural factors you think kept institutional capital on the sidelines? And what do you think, what was the major move their catalyst that started to change that dynamic?
Certainly. Well, I think that structurally, a lot of institutional capital simply had better alternatives. There's a lot of an ability to invest, even now in the AI boom. Previous to that, you saw a tremendous movement in cannabis. In terms of non-institutional capital, a lot of it went into crypto. Now we're seeing some institutions enter and dabble into that space. And so there are all these alternatives. Historically, the role of the metals and mining market has been essentially to absorb liquidity as a speculative asset. So when companies or individuals or funds wanted to have multiple returns on their fund, their singular mechanism for doing so would be the metals and mining market primarily. What we're seeing is even if you look at companies like the Magnificent Seven or NVIDIA today, these mega cap companies can deliver these spectacular returns. What I think is so interesting is that even in an era where we still have all of these alternatives, with AI, we have one of the biggest alternatives, we're still seeing a tremendous amount of capital and institutional capital flowing into these companies. And I think, ultimately into bullion. I think what we're also seeing, though, is a lot of central bank buying. And so I think that if you actually look at the price and try to allocate how much is driven by institutions versus how much is driven by central banks, you'll actually see that the majority of it is driven by central banks.
Sure.
And the price on the companies is being driven by, well, a re-rating from bullion. And so I think a lot of institutional capital continues to be on the sideline. And so the question to ask is, what happens to the share price of these companies and to this industry as that institutional capital truly starts to flow in?
It's I mean, you know me, I've become a gold bug in the last year and a half. Like I used to make fun of gold bugs, and I've become one, so that's a full circle kind of moment for me. But people kept saying, look, retail is getting into gold because the price is moving up. But it's not really, like, the story is that Chinese and central banks through Central Asia and Latin America have been buying all the gold. So there's still room, I think, for retail to get excited and jump in, is kind of my instinct on it. And I think people saying this is a retail story are kind of wrong. Like, I don't actually think that's happened yet.
Certainly, I think that the retail buying that's happening isn't because the price is moving up. I think it's because people don't trust their governments. In Canada, for example, I think about 10 years ago, the Canadian Central Bank sold all of its gold. And at the time, under Trudeau, the idea was, well, this is a legacy instrument, we don't need it. And trust in governments, and in governments in particular, was very, very high. If we look at the world today, things look very different. And I think subsequently, because of how different things look, trust in governments is at an all-time low. And as they like to say, as I like to say, and as many others say, gold is a hedge against stupidity. And so I think we're seeing a lot of concerned individuals buying bullion and getting into this space, not necessarily because the price is moving up, but because relatively everything else is at risk of producing very bad financial results for those individuals if things go awry.
I like hedge against stupidity because, you know, when you're in stupid times, you want to own as much of the hedge as you can, I think. And it's interesting. Almost every time I've heard of a government selling a bunch of gold, like famously Gordon Brown sold all of England's gold at like a 5-year low, you almost always look foolish very quickly. Like, it's trust in government and don't trust in, hedge. You look like a dummy, I think, the vast majority of the time. And I don't think there's many historical periods that would actually refute that. So interesting. But I know we've talked about gold already. I'm going to get back into it. But I do want to talk quickly about critical minerals, defense materials, and strategic resources too. We'll call this the Trump effect. A lot of my clients and folks in the market say sometimes you never know what Trump's going to say, and that can massively swing markets one way or the other. I think it's obvious that this administration and the world generally is shifting towards getting domestic sources of strategic resources. That's for national security reasons, it's for strategic reasons, for a million reasons. What subsectors are you currently seeing the most institutional interest in?
I think we're seeing it in anything that, like to your point with critical minerals, we're seeing it in anything that is involved in the production, especially of anything that is a utility or a defense. Recently, they actually even went as far as including silver as a critical mineral.
Sure.
And so I think that it's secular across the board, where anything that's in that category is generally attracting capital and interest.
And you can see, I mean, making silver a critical mineral, I think, is an interesting choice, and one I don't necessarily disagree with, because there's a lot of strategic value for electrification that you need it for. There's even talks, you know, we're in rumor mill land now, of gold potentially being classified as a critical mineral for federal funding. I think that's interesting too, because, I mean, one, as we talked about, there is strategic geopolitical value in producing and hoarding gold, to be honest. So where do you think that might go in the future? You think that's possible?
And certainly, I think in many ways that's already informally beginning to happen.
Mm.
Like in terms of some of the recent policy moves that Trump has made, where importing gold has a tariff, and therefore if you actually smelt it locally within the United States, you avoid that tariff. We're seeing a lot of reshoring of gold bullion and that a part of the supply chain in the United States directly. And so I think already a lot of this is happening, where the goal of the United States is to bring gold bullion onto the United States land.
Yeah, and I can't disagree with the policy myself. I mean, I think it's certainly something that I would probably be pursuing in the same position. But it makes me want to zoom out for a second and talk about broader securities markets. Because I know people who work in gold and mining, us included, tend to have a reputation as perma bears, and I don't think that's necessarily untrue. We're always bracing for collapse to some one degree or another. But I think more investors now, generalists, are questioning whether we're headed for a broader bear market. There's the bulls that think the line will never go down, but I think a lot of people are kind of bracing for even potentially a 2008 style event. So I will ask you, I love making people predict the future. It's my personal hobby. What's your assessment of the current risk environment for equity markets broadly, the S&P?
Certainly. Well, my view is that it's both. A large part of why we're seeing reductions in interest rates is on the view that the economy is being weak. And on the view that the economy is being weak, that's driving the equities market because that's financial engineering in terms of lower interest rates, more speculation, and so forth. And so you have these two forces that are running in tandem. And ultimately, one of them is going to break first. And typically, it's the economy. And once the economy breaks, usually what you have are those 2008 style recessions or where you have those corrections. And then on the flip side, you have the recovery. I think what's notable is you have to pay a lot of attention to which market you're trading in and where your assets are located. In the United States, typically these recessionary periods tend to be fairly quick, and the bull runs tend to be much, much longer. Right now, we're in a decade-long bull run, depending on how you want to count it and measure it, and there's debate back and forth. But it's been a very, very long time since something like 2008. And so that's not true in a lot of other markets. Like if you look at the Canadian economy as an example, I'd say that it's in a financial depression.
Sure.
So looking at the exposure that your portfolio has to different markets, I think will tell you a different answer in terms of timing.
Yeah, and I do think that's an interesting point because you see this online all the time. People talk about the economy, and what they mean is America. When you look at Europe, stagnant. Canada's been stagnant at best. So you're right. I mean, it really depends on where you're looking at. I want to talk about the correlation between broad equities and then the mining stocks generally, because I know that correlation has intensified in recent years. And you kind of don't see stocks acting like you'd expect them to. In the case of a broad downturn, one of those short recessionary periods that you're talking about, how should mining investors position themselves, and what should they expect for mining equities during that kind of period?
Well, generally, mining responds very volatile, very volatile. So if you think, let's look through different stages of a company's lifespan. In the context of an exploration stage company, it needs to have the ability to finance its exploration, which costs tens of millions of dollars to do effectively. If we're going to do a 10,000 plus meter diamond drilling program or 40,000 meter diamond drilling program, that costs many millions and millions of dollars. And so the company needs the ability to raise that capital. And part of that ability to raise capital is, well, what is the bullion price? So ultimately of the asset that they're seeking, usually, well, in this example, let's say it's gold. And what is the prospect of what the gold price is going to do? The higher the price, the easier it is to raise capital because the more the value there is under the ground. And so in a recessionary situation, if the bullion price goes down, the appetite to recover the bullion from underneath the ground in order to take it over the ground and then put it back in the ground in a safe goes way down. So that's, I'd say, on the exploration side. And so you can see appetites and attitudes change very, very rapidly in that context. And this analysis generally holds true across the spectrum. The appetite to advance a development stage company forward, or the appetite to go and produce more gold or whatever commodity happens to be at a higher scale and magnitude. All of these things are affected ultimately by the underlying commodity price of the resource that's being produced. And so to that end, if appetites go negative, things can change very, very quickly. But the flip side of that is also true. Where that bullion price goes up, the appetite to go and conduct large exploration programs to find more bullion goes much higher. The appetite to bring projects from development into production goes much higher. The appetite to increase the scale of production goes much higher. And so the only guarantee is that there is volatility.
Yeah, no, that makes sense. And mining investors, longtime mining investors, know to brace themselves. These are a thick-skinned crowd for the most part, or at least develop thick skin fairly quickly. But I want to get back to complaining about Canada, which is obviously a hobby of mine. I know it's a hobby of yours too. Canada traditionally has been a global hub, if not the global hub for mining finance. But we've seen challenges with competitiveness. My question to you is, what is Canada doing right in terms of supporting the resource sector, and where are we falling short? Where do you think things could shore up?
I think the only thing that we're doing right is that because government of Canada is generally inefficient and ineffective at doing things, it hasn't caused more harm than it could because it just hasn't passed those resolutions.
Yeah, sure.
The only thing that I'd say the government of Canada is doing correctly is it's being inefficient enough that things aren't moving as fast as I'm sure they want things to. In terms of what they're doing wrong, there's been a lot of changes that I think have been horrible for the sector. We've seen changes in how taxation policy treats flow-through investing. As a result of that, the willingness and interest for people to participate in flow-throughs has gone way down. We've seen errors in terms of even taxation around capital gains, where the increase of the capital gains tax, I think from 25% to 33%, and there's a whole number of mechanisms which ultimately got reversed a year later. That spooked a lot and caused a lot of fear in the market. And so pretty much every decision that the government could make to make things worse has largely been what's been happening so far. And so I think we're seeing that reflected even as recently as us alluded in Canada being one of the top mining jurisdictions, which it's held that title for decades, to Finland. Sure. And so very much I think that we're going in the wrong direction. And the way to save it is to basically reverse the policies that have been made and implement some of the recommendations we've been making with the Safe Canadian Mining movement. And there's been various voices and different ideas, but I think that's generally directionally correct.
Yeah, losing to a Nordic country, which famously has a lot of regulatory red tape, et cetera, that's tough. It's tough to bear. One comparison that I'm eager to chat about is the difference between the Canadian environment and Australia and the US. I know there's obviously a million differences. ASX share count's the one that usually comes up. Every company's got 6 billion shares out or something. But what do you think Australia and to some degree the US too are doing right that Canada isn't?
Well, I think I'll start with the United States, which is I think that generally it's a much stronger market. Mm-hmm. So the market itself is much stronger. There's also a greater history of making money in the capital markets. And so as a result, culturally, deals move much, much faster. And I think that's why people like to do business in the United States, because you can get things done very, very quickly. There's less of a risk-averse appetite. It's more greed-oriented, and that reflects speed of decisions and ultimately in great innovations and deals and things of that sort emerging. In the Canadian context, I think it's the reverse, where folks that have invested in the Canadian capital markets historically haven't done so well.
Yeah, sure.
And so there's that feedback loop where it's more of a risk-averse environment. The other aspect is that when you have returns, you can reinvest those returns. When you lose money, you're not able to reinvest it as easily. And I think that's largely the story of the Canadian market. There's also a tremendous amount of brain drain ongoing from Canada into the United States and into other parts of the world, both on an individual talent level. I think Canadian and Canada broadly is starved for talent as much as it's starved for capital. And many mining companies complain that they can't hire the people that they need locally. Sure. The other aspect is that a lot of that talent ends up moving elsewhere. And then the benefits of that talent, whether it's in the United States or abroad, tends to compound in those areas. And so the combination of those factors is significant. In the Australian context, I think what's different is that they're very supportive of their rich history in mining. And so the government is generally more supportive. The stock exchanges are generally more supportive and understanding. But the rules are different. I hear very often people complain about their being listed on Canadian stock exchanges. And I hear similarly many people being very fond of being on the Australian stock exchanges in terms of policy, in terms of the policies that they have to abide by, the cost per year to maintain the listing, and various other factors.
Yeah, let's actually talk about the TSX for a second, because certainly been a trend in the recent days. Majors are delisting from the TSX. Juniors are looking to dual list elsewhere. Do you think this is one a symptom of a deep issue with the Canadian market? And what do you think the TSX can do to revitalize the funding platform?
Certainly. Well, I think that the TSX largely is oriented around trying to be much more in the senior space. And I think to that end, a lot of the policy requirements that they have of juniors is that they're going to treat a junior company as they would a senior company. That means a lot of overhead, a lot of regulatory filings. And if you actually look at some of the conversations in the United States, particularly with Trump, where the proposition is, let's move away from quarterly earnings and quarterly reporting, biannual reporting, you see the exact opposite mentality in other markets. And I think that that is kind of the fundamental disconnect, where in large part, because of the burden of being listed and the speed at which listed companies are able to operate, because they have to get regulatory approval from the exchange, there's a lot of issues that emerge from it, to the point where a lot of companies feel that they can either list elsewhere or delist entirely and go private, because the benefit that they get in moving quicker outweighs any sort of benefits that they get in not being able to attract capital from the exchange. And notably, the exchange has had, and the TSX and TSXV in particular, have had some of the lowest liquidity volumes, I think, in the last decade or 2 decades. And so a lot of the benefits and promises of being on an exchange and being able to access capital simply aren't coming true. Additionally, and you saw this, I think, in Beaver Creek, a lot of the activity of fundraising is meeting with investors in person or meeting with them through digital platforms like ours. And it's not so much a function of the exchange bringing investors in, as much as companies going out and reaching out and making relationships directly with investors. And so I think a lot of companies are looking at that calculus and they're frustrated by it. I know a lot have already delisted and many others are very tempted to, but they feel pretty much caught where they don't want to delist because obviously they have shareholders and they don't want to cause other issues, but they're very frustrated by this situation. The ideal solution, I think, is just better governance and better policies on the part of the exchange and on the part of the Canadian government.
Yeah, you can kind of get in the hole, I think, race the TSX. I don't think any company I know has like a very fond relationship with the TSX. It's begrudging. It's like like stuck with, I think, how most people treat it. I want to talk investment strategy and kind of outlook for a second before we crystal ball gaze even more. And that's from a capital allocation perspective. How do you think institutional investors should be looking at mining exposure with the macro environment, but also those long-term commodity demand trends? If you were to give advice to them, what would it be right now?
Certainly. Well, I think bullion is a starting point. So certainly allocating capital into bullion. Additionally, I'd say looking down the value chain. And my view is very simple, which is if you want a conservative approach, take whatever percent you want to allocate to the metals and mining space, have bullion be a major component, then majors, then mid-tiers, then juniors. And then the level of risk tolerance and appetite that you have should proportionally reflect that. So if you're risk adverse, put more into the majors, less into the juniors. If you're more risk oriented and you want to have higher returns or the potential for higher returns, flip it and have more in the juniors and less in the majors and bullion. But I think that every institution ought to be oriented around putting capital in the metals and mining sector.
Yeah, it's quick look at Exeter's pyramids. I think we're moving towards we're moving towards that end of the pyramid anyways. People get less and less faith in government. One thing I wanted to, and this is where we're talking deep future now, so it's really, I'm asking you to crystal ball gaze to the best of your ability. Looking forward, we'll call it a year and a half. What are you going to be watching to gauge whether this is a sustained recovery for mining equities? Because we haven't seen a real bull market in quite some time in mining. So what are you going to be looking for to see if this is actually sustained or if this is another blip like we saw in 2021? And as a corollary to that, what advice are you giving to companies to access capital right now?
Certainly. Well, I think there's a number of different indicators, right? One is looking at the funding flows. If companies are able to raise capital, and they're able to do so in large volumes at generally good or reasonable valuations, it's a frothy market. If funding starts to dry up, that's usually the sign that investor appetite has changed. And the more difficult it is to raise funding, typically that's an indicator. And there could be some debate is a lagging indicator or leading, but that's certainly one indicator to look at. Other aspects are looking at bullion price, which I'd say is probably one of the best leading indicators of what's going to happen. Typically, we see a cascading effect, like I mentioned earlier, where first bullion moves, then the majors move, and then the development and exploration companies move. And so you can largely look at bullion price as a leading indicator of what's going to happen down the value chain. Additionally, what I like to look at personally as well is M2 money supply. Traditionally, as there's more money in the money supply, prices of equities go up, prices of commodities go up. As liquidity gets out of the system, prices of equities and commodities go down. And so I look at it largely through that way. I also like to look at Bitcoin and Ethereum and see what's happening in those alternative markets. In the last 10 years or so, my view is that it's been a fairly good indicator of liquidity because it tends to absorb liquidity. Right now, we're seeing, I think, some interesting behavior between Bitcoin and gold, where Bitcoin is actually going down and gold is going up. And I think that there is probably something there that we're going to find out what exactly is driving that maybe in a few months. But I think that's something certainly to look at also as a leading indicator.
That's actually, I want to bounce off that because I'm just curious. I don't follow crypto as much as you do, and I certainly don't have any money in it. What do you think crypto does in a real bear market? Like, we got a sense of your opinion on what gold does, and I agree. What do you think the price of Bitcoin specifically does in like a real crash?
I think there's a lot of aspects of what we mean when we say a bear market, right? Are we talking about the economy or are we talking about the stock market?
Let's say it's the stock market specifically. So let's say there's a stock market crash. What do you think Bitcoin does?
Yeah, so I think in the context of a bear market, the price goes down. Right? I think that's very largely what tends to be very annoying about bear markets is that everything goes down all
Sure.
at once.
Yeah,
And
sure.
where the opportunity arises in a bear market is the relative value between things going down. So what goes down a lot versus what goes down a little. So for example, if Bitcoin goes to, let's say, to $1, that's a huge wipeout. If gold goes to $1, that's a huge wipeout.
Sure.
Conversely, if equities go to $1, that's also a huge wipeout. The analysis that I gave earlier in terms of mining companies, where if there's not a desire to get the gold out of the ground, suddenly that can add like 3 years of delays between anything happening.
At least, yeah.
That's going to very quickly remove the desire and interest for someone to be an owner of that stock, because they figure, well, nothing's going to happen for 3 years. I can get back in 2.5 years. And so I think what's notable about Bitcoin and about bullion and a lot of these assets that have value is that they can move much more rapidly because there isn't any counterparty risk. And so typically, I think the swings are going to be more immediate, and it's be more immediate in both directions. And the insight that I would share about this is that if you know that that's how these assets behave immediately, and if you know that typically juniors and the metals and mining market behave with a laggard effect, it means that you can, to some degree of reliability, make money by just front-running that laggard effect in terms of if you see bullion moving fast and you know it's going to hit the juniors. Maybe you want to look at the juniors, get positioned, because you still have some time before the junior prices reflect that.
Awesome. Yeah.
To answer your question of kind of how I'd position it, if I think a bear market is coming, largely it would be trying to position things so that the assets which fall the least, and then I can rotate to ultimately kind of ride it back up and then rotate it into the assets that I think are going to do well with that laggard effect.
Yeah, because that's, I think, it's figuring out what's going to drop the least, but also what recovers the fastest. It's the common wisdom. Common wisdom's often proven wrong, but the common wisdom is like, everything goes down when a crash happens, as you said, but mining stocks and gold pick up quickly afterwards. So I guess my question there, to go back, how quickly do you think crypto, Bitcoin specifically, recovers in the case of a crash? You think it's one of the early runners, or do you think it takes a million years like everything else?
It's a mix. There's a lot of great analysis that's been done looking at the duration between crypto crashes and then when they go and they hit their price and their recovery. Generally, the pattern that I've seen is it can be, I think this is the most recent, this is the most recent cycle. I think it took 3 years before it hit from where the peak was before the crash, and then where it hit that point of being equal to where the peak was with inflation unadjusted. And then after that point, it took off and I think increased fairly substantially. I think now double what it was in the previous cycle or something like that.
I appreciate that. Well, Daniel, thank you for letting me grill you for a half hour. I think this was fun. I learned a lot. I always like when I do. Appreciate all your insights. And for those watching, if you have any questions, please let us know. We'd love to hear from you and answer any questions you might have. And again, if you are interested in seeing any company on this platform, please do hit that feedback button on the top right of your screen when you're watching this replay and let us know who you'd like to see. We'd love to get in touch with them. But Daniel, thank you for your time. This was a lot of fun.
Pleasure, yeah.